Hello everyone, this is James Song here. Welcome back to my video and I'm starting something new today. Today I'll start reviewing a finance movie. This is a documentary film and I'm doing this obviously to create some fun contents for you guys. I want to do 5 to 10 movies, 5 to 10 finance movies and do a review for you so you can have some fun, hopefully. That's main objective, and learn something valuable, and we can have a good time, right? And I chose Inside Job as my first movie, so hopefully if this works well, so please uh from this video onwards, if you like the content, please give me some feedback that I like this content, this is fun, I'm learning something new. Please keep doing this type of content. Please let me know. Then, I can use that feedback to continue doing more work, right? It's a documentary film, so it's very resourceful and it covers what happened in 2008 uh, financial crisis, global financial crisis, and it gives some background information, knowledge, and history of how financial service sector has developed over the years. So this is a perfect foundation to learn from, and we can use what we learn from this movie to enjoy other movies in the future like Big Short and Margin Call and movies like that, right? So that's why I'm doing this movie as my first one. So the movie starts with a black screen, and there's some text, some information to start the movie. It says global economic crisis of 2008 cost tens of millions of people their savings, their jobs, and their homes. Essentially, it became a global recession for a number of years, and this is how it happened. So, director clearly tells us that this movie will tell us how global economic crisis of 2008 happened. Okay, and the very first scene, the picture we get is actually Iceland. Before that, let me backtrack a little bit. Let me give you the structure of this movie parts. There are 5 parts, actually 6 parts, although he doesn't call it six. So there is like a part zero. He doesn't call this anything. So there is a very strong introduction section, and the director of the movie gives the main idea very directly. And then we move on to the body paragraph, part one. How we got here, I think. Sorry if I'm not entirely accurate. It talks about the history of financial service sector. Part two, bubble. So how the housing bubbles were created before the burst, which was 2008. And part three, sadly, the crisis. Actually, I still remember that so vividly because during the crisis, I was still working in financial service industry. Of course, I wasn't a big guy or bad guy, making a lot of money. I was just a junior guy. I was in my 20s trying to survive, trying to make a living by working in financial service industry. So, it was huge shock. Part four is accountability. So aftermath of the crisis and who is responsible, why and how. And part five is his conclusion. He wraps it all up by giving his final overall evaluation of the current state of US and US economy. I think he calls it Where We Are Now. Okay, so let's go. So this part is quite important. So when the first picture you get is actually Iceland. This introduction part before part one is really important because director of the movie so cleverly created a snapshot metaphor, like an analogous example, to briefly explain what happened to New York in a nutshell. Okay, so please concentrate and learn everything you can during the introductory part of the movie. It says something like $13 billion, I think, and bank losses 100 billion. So this information is given for you to think like, what the hell? What's wrong with this company? What happened to these banks? Like, how did they manage to lose 8 times their entire annual GDP? This is crazy. The voice of Matt Damon comes in to play. He's a narrator, obviously acting, representing the perspective of the director of this movie. And according to Matt Damon, 2000 Iceland government deregulation had tragic consequences. Okay, so what was the deregulation? Deregulation, sorry, spelling. Okay, they let three of their largest local banks, domestic banks, commercial banks, to privatize. What happened? They went crazy, according to the movie. They three banks in 5 years, 5 years, three banks borrowed $120 billion, right? I think I remember. So that's almost 10 times or 9 times the annual GDP they managed to use, borrow, invest, or crazily spent in 5 years. So it's run in a super risky way, right? And there are 2 points that you have to keep in mind when you're watching this. The interesting points that will later you have to really understand what happened to New York. Interesting thing is at this point, so this is before these banks went bankrupt in 2008. Um, they were actually audited by accounting firms, KPMG, and KPMG gave them a report, the final verdict, there is nothing wrong. It's fine. That's weird. Like you have to think like, how is this possible? And even worse, credit rating agency, as you know, Moody's, S&P, Fitch, the agencies that give credit rating for anything, mostly companies and even government, as an investment. So if you rate something as an investment, how good, how bad are they? And this movie says these crazy banks of Iceland that taking tons of risk and spending ridiculous amount of money, they gave investment grade as a triple A. Then it's a best possible investment ever. Okay, triple A. So keep in mind, like, what the hell is happening? Okay, how is this possible? And the answers will be revealed to you. Okay, and lastly, director claims that regulators did not do anything. Okay, did nothing, did a terrible job in trying to stop or trying to protect the investors' money and punish these banks, right? So we want to know what happened, what they do and or what they didn't do, and why they acted that way and how, right? So keep that in mind. Let's go. So now we are at the end of Iceland with a super exciting music. We are flying to New York. Okay. And introduction continue. When we get to New York, there is a terrible news report. Says September 15th, 2008, the day Lehman Brothers declare bankrupt. I remember this day. I shouldn't laugh. I'm not laughing. It's just dumbfounded. It's so strange. It's so surreal still to this day. I was going to work during those times, and I felt like I was watching a movie, but the problem was I was in it and I wasn't acting, and it was a reality. Okay. So news reports, blah blah blah, and the day where financial system stopped and froze due to, and stock market did this, okay, due to bankruptcy of Lehman Brothers. Okay. And then director so boldly, bravely gives his thesis right here. He says this global financial crisis is not an accident. It was caused by financial service industry itself, themselves. So there is a villain, there is a criminal. So financial service industry created, caused this global financial crisis. That is director's thesis. And he backs it up with one sentence reasoning. He says from 80s, there were a series of financial crises, number of them, but each and every time the damages got bigger. But industry, these insiders made even more and more money through every crisis. So this is the main idea of the movie by the director. Okay. And then part one begins. He talks about, I think it's how we got here. So basically, he talks about the history of the financial service industry in US. And he claims from end of Great Depression, 1940s to 1980s, for 40 years, US experienced stable economic growth without any, not even one, financial crisis. And the reason is, the director claims, because financial service industry was tightly regulated. Okay. All right. So how were they regulated? Let me tell you. So old banking system, Glass. There's a name of the law I'm looking for. Glass-Steagall Act, I think. Sorry if my spelling is off. But anyway, there was this law, which I'll explain to you in a minute. So all the banking system, so banking sector, financial sector has many different type of institution. But if I have to categorize into two biggest institution, one is a commercial bank, the other is an investment bank. Okay. And commercial bank is your local bank. Everyday people, average Joe, average James, okay? Just the general public deposit their savings, okay? and get a loans from the bank, usually home loans, mortgages. Okay, 30-year commitment. If you think about it, it's a huge commitment. Yeah, I mean, 30 years. Okay, and investment bank, um, as name applies, uh, it's allowed to make different types of risky investments to make profit. Okay, so they are not allowed to receive deposit money, and so they have to use their own money, or they have to find investors who are willing to put their money into more risky investments. That's investment bank. Okay, and one thing I forgot to mention when I was explaining commercial bank, because by law they are allowed to take individuals' deposit money, savings, they are very tightly regulated so that these banks cannot use this deposit money to risky investment and lose it. They are not allowed to make risky investments with their received deposit money. Whereas investment bank, they're more free to do pretty much whatever they want. Okay, but they are not allowed to receive individuals' deposit. Okay, and what is a Glass-Steagall Act? This act makes sure that commercial bank and investment banks have to be separated. They cannot merge or acquire each other. Okay, that's Glass-Steagall Act. So according to the director, director is claiming that this kind of a tight regulation enable U.S. to not have financial crisis with stable annual economic growth. So those were the good times, according to the director. Something changed when Ronald Reagan, came into power as president in 1980s. He started deregulation that is lasting forever until now, basically. Okay, so what was the start of deregulation? He let savings and loans company. He created a lot of loopholes to enable savings and loans company to be able to invest the depositors' money into risky investment. This was the regulation change. And what do you think happened? Okay, tragically, this ended up in huge financial crisis. Okay, these savings and loans company, many of them went bankrupt, and so sadly lost a lot of depositors' money. So everyday James's life savings, and a lot of victims were created, and it was total disaster. And one thing you have to understand, I'm sure probably you did already, savings and loans company belong to commercial banking sector if we have to categorize them. So savings and loans company, as the name applies, does exactly same function as commercial banks, as I explained a couple of minutes ago. So they take deposit money and they give out loans. But why are they called savings and loans company? Probably they are smaller than banks, and they may not have the features that you must have to qualify to be defined as banks. So, they must be smaller than banks and don't have all the qualification and features necessary to be called as a commercial bank. But essentially, it's the same line of business. Okay. And it's kind of illegal. It's very cheeky, to say the least. It's criminal, okay? Because you still have Glass-Steagall Act, if I spelt it correctly. Then like fundamentally, you are not allowed to allow this kind of deregulation, but they did some naughty things, naughty, okay, to make this kind of detailed deregulation to do these things, and general public lost their money. And what happens next? What do you expect? Okay, if you are like directors at this point, the government and regulators must wake up once for all and start tightening regulation, right? Okay, learn from their experience. But reality is exactly opposite. Through Bush administration and Clinton administration, deregulation continued. Okay, don't ask me why. Probably the banks had a lot of lobbying power because lobbying is legal in US. So they, spend a lot of money in lobbying the government and the politicians, left and right, Republican and Democrats. And, they continue to deregulate. Okay. And there is a critical figure in the history of financial sector called Alan Greenspan. So this guy was a chairman of Federal Reserve for about 20 years, almost 20 years, probably a little bit shorter than that. And if I remember correctly, he was appointed by 4 different presidents to be chairman of Federal Reserve. Okay. And he is an instrumental figure who continued to deregulate financial service industry. Okay. And there is a landmark event, landmark moment. 1998, back then Citicorp, I think it was, and Travelers merged. This was a landmark event, okay? Why it was landmark? It created Citigroup, which became the largest financial service company in the world. But more importantly, fundamentally, Citicorp, commercial bank business. Although by 1998, there were so many deregulation, even at this point, Citicorp did so many different things. Okay. Travelers, fundamentally, insurance company. But the problem was the most profitable and very large side of Travelers business was indeed investment banking, called Salomon Smith Barney. Okay. So if what was the name? Sorry, short-term memory problem. Okay. What was that bloody law's name? Glass-Steagall. Sorry. Okay. If the Glass-Steagall Act was in effect, then this merge cannot happen. This is illegal because it's commercial bank trying to merge with investment bank. But what happened in reality? But Alan Greenspan didn't say anything, just kept quiet. And for some amazing reason, the regulator gave this merge 1 year exemption. I don't know how this is possible, but they did. Okay. And then, yeah, within that 1 year, this Citigroup, okay, managed to lobby the government and politics to create a new law that enable this merge as a permanent. Okay? Amazing, right? So the problem is now commercial bank and investment bank are not separated. That the importance that I explained a few minutes ago about how these different sectors are separated to reduce the risk is eliminated. And in the movie, at this point, George Soros makes a really great analogous example with oil tankers. To reduce risk, if you are transporting dangerous oil, okay, if there is an oil leak, then it's a trouble, right? It's a risk. So you have to keep them separated into different compartments. That's how you reduce risk, like Glass-Steagall, like commercial bank, investment bank, separated. So investment banking risk do not transfer onto commercial banking, right? So, even oil leaks here, it stops here. It doesn't affect other compartments. But with this Citigroup merger, Citicorp and Travelers merger means there is no longer compartments. So everyone is affected in every way. If something goes bad, then other institution would possibly be more negatively affected from now on due to this merger and due to this kind of lack of separation. Okay, so let's talk about derivatives. So for me to define, being a detail guy that I am, for me to define derivatives with definition, reasons, and example, it will easily take me like 30 minutes to an hour. So I'm not going to do that. Let's simply define derivatives as a very complex and creative, I guess, financial products. Okay. So derivatives can be anything. More traditional derivatives are like oil prices, pork belly, so commodities, and foreign exchange. All those things are derivatives that you can invest in or gamble with. Or nowadays, even like possibility of certain companies going bankruptcy, as long as this financial institution can somehow make financial products out of it, then it's all derivatives. Options and futures are derivatives. And it means like sky's the limit. Like it's up to your imagination. You know, people in the industry can create any kind of complex products and call it derivatives. Okay. And because options and futures are derivatives, Another easier way to understand if you want a little bit more detail is like when you're sports betting, the main bet is England playing Germany in football. That is like a stock. That's like an Apple stock or Microsoft stock or something like that, right? In comparison, as an analogy. And derivatives are all these side bets you can basically create. So first goal scorer, okay? Harry Kane, 1 to 5. Okay, every $1 you bet, you get $5 in return. And you get 18 different strikers as a financial products that you can bet on. So these side bets, like not the final results, who's going to win, that's more traditional investment, like a stock. And derivatives are all these side bets. Okay, if that helps you understand a little better. Okay, and CDOs, types of derivatives that is totally responsible in causing financial crisis in 2008. They are example of derivatives, and I'm going to explain this in a short while, so you can kind of learn this way. Okay, so that's an example of derivatives products. Okay, I understood. All right, so I'll tell you about it. And something really weird happened as you watch the movie. In 2000, already by end of 90s, I cannot remember the numbers. I'm sorry, guys. But in the movie, it says something like 50 trillion or some ridiculous numbers. So derivatives became a very big market with a lot of money flowing in. Yeah. And it wasn't tightly regulated. And another name you can keep in mind, not as important as Alan Greenspan. Another name is Larry Summers. He was Harvard economic professor, became Treasury Secretary during Bill Clinton's second term as a president. He was Treasury Secretary, if I'm not wrong, around like 96 to 99, something like that. Okay, during this time. Okay. And he was an instrumental figure who made this new law passed. Sorry, I cannot remember the exact name of the law. Watch the movie to get the exact spelling. The government and regulator managed to pass this law that says basically derivatives cannot, should not, will not be regulated. This is the law itself. They're trying to do something bad. They're going to hide something. Okay, we get regulation that kind of put a stop to something. We see that often, but we don't see an act, law, regulation that prevent something from being regulated. Now the stage is set to really go for it, because now law is in place that derivatives are not to be regulated. That's a regulation itself. Okay? So huge change in financial sector. So all the big institutions, they are encouraged to create more derivatives and create more profit. Okay? And this is end of part 1. And we need to move on to part 2, bubble. But right here, we face the most important section of the movie you must understand. Let me start this right now. It's around 27 minutes, I think, in the movie to 31 minutes mark in the movie. This is super important, most important part of the movie. And you must understand this part to be able to understand what happened in the 2008 global financial crisis. But it's, don't worry, it's not hard. I understood. So everyone can understand it. It's really simple. But this is the most important part because you have to understand this part to understand how mortgage securities were created, mortgage-backed securities, I should say. Terminology is not important. And how investment bank created CDOs and what are CDOs. You need to understand that to understand what is going on. So in a traditional banking model, before they call it, they gave a real scary name. Securitization food chain in the movie. So you need to understand this to be able to understand Big Short, Margin Call, and all the fun movies I'm going to cover in the future. So pay attention. Here we go. Let's go, guys. So before securitization food chain, okay, securitization, making something into security, nothing more than that. It's a fancy word, but it just means making something into financial product. That's all it means, okay? So before this, the traditional model, if you want to get a home loan, okay, borrowers go to the bank. There are two parties involved. That's it, okay? You apply to get a home loan. And if you get the home loan, then you pay monthly payment back to the bank that you got the money from. It's a 30 years loan usually. Okay, so individuals not to default and make all the payments, that's 30 times 12, so 360 monthly payment. Okay, each and every time usually borrowers pay a little bit of principal, what he borrowed, plus interest, or interest only depending on what kind of loan you are paying off. Okay, this was it. It was not securitized. It was just a home loan. Okay, that's an old model. But through securitization, what happened is that, so this is what happened. So there's borrowers, there's a lender, there is an investment bank, and there are investors. There are four parties involved. Okay? So when the borrowers got the home loan from the bank, okay, when they pay their monthly payment to the lenders, and the lenders, this commercial bank, the home loan is really kind of boring, not very profitable, kind of high risk, dangerous product they have to keep because they have to keep for 30 years. And this guy has to pay the bank back every month for 30 years. It's a risk, okay? And they just earn interest as a profit, which may not be very high. And investment bank says, okay, I'm going to buy that home loan from you. Sell it to me. Okay? So banks are happy. They get rid of 30-year risk, low profit. They transfer all their risk to investment bank. So the mortgage, the $1 million mortgage are off their book. They sold it. And also they earn a fee, profit, by selling this awful risky product. So banks are really happy to be able to sell the mortgages to investment banks because they can make money, plus they can get rid of this risk. Okay? So the question is, why the hell these investment banks would buy these mortgages? The reason is they can create derivatives products out of it. Okay? So as the movie explains, they buy everything from everyone. They buy home loans, they buy commercial mortgages. So this is a residential mortgages, home loans, commercial mortgages, mortgages for office building, good loans, bad loans, all kind of residential mortgages and commercial mortgages. They buy car loans from different company and also from the banks. They buy student loans. They buy personal loans. They buy all these loans, right? And what do? They mix it together. They create financial innovation. They create complex, hard to understand, sophisticated financial products called derivatives, which is, in essence, bullshit. SHIT. They create SHIT, that everything is mixed together, and they call it something else. Okay? They create this SHIT product called CDOs. This is a collateralized debt obligation. What a bullshit name. Okay? CDOs. So these are CDOs. So why do they buy mortgages from the banks? Because they want to create these CDOs. And why are they creating these CDOs? Because they can sell it. They sell this SHIT to investors, to everyone, to institution, to individuals, to pension fund, to everyone. Okay? And why would the investor buy this SHIT? Nobody's an idiot. This is really interesting, guys. This is really tragic. This is as fraud that it can be. It's immoral, unethical. It's totally fraudulent, in my opinion. So when they make CDOs, they pay the rating agencies. They pay Moody's, Standard & Poor's, and Fitch to give these CDOs AAA rating or very high rating. This is unbelievable, but this is 100% fact. This is not an opinion. This is not a fiction. This is exactly how the industry worked, because there is no regulation in derivatives. I shouldn't say no. There is a very little regulation, if I may correct myself, in derivatives. This kind of SHIT can be created, and I don't know about rating agency. It's almost like if it was like a media company. These big companies give money to New York Times to write good articles for them. Okay, but that's how the industry worked and still works, to be honest. Okay, rating agency get paid to give good ratings to companies. They're a customer, investment banks, CDOs. This is horrible, but this is what happened. Okay, And real sad part is because rating agencies are somewhat credible, many investment decisions are made by this rating. So some of the pension funds or retirement funds, they have this clause, they have this rule that because we are safe and conservative fund, we are only allowed to buy triple A products into our fund to invest, to protect our investors. But the problem is the industry is so corrupt that this SHIT gets triple A from Moody's and Standard Poor's. And these retirement funds consist of what money? The life savings of these innocent, hardworking, general public individuals. And what do you think happened in 2008? Everybody lost money. And many poor people that put their entire life savings lost money. This is a tragedy. And the worst part is this is reality. Okay? So, at this point, after this explanation from the movie, the interviewer, the director of the movie, asks incredibly sharp, smart, and intelligent questions to interviewee. He asks, I'm paraphrasing, sorry guys. He asks something along the lines of, couldn't investment bank still make good quality products as a derivatives and try to sell good quality investment products to their investors, like safer, better quality mortgages to the market rather than subprime mortgage products? Couldn't investment bank make good quality products and sell it to the investors? And answer is, of course they could have. They should have. They must have. But they didn't. And another question director asks the interviewee is, do you think these guys, these investment bankers, created CDOs, did they know that they were doing something dangerous? What do you think the answer is? Of course they knew. They intentionally do it. Okay? To make things more profitable. Okay? Think about this, guys. Now I'm moving to the bubble part of the movie. But now it's really a problem because nobody cares. The banks, the lender of mortgages, care less than before because even if they make the bad loans to people who have low income or lending, borrowing larger percentage of the housing price, it doesn't matter as long as these banks can sell those mortgages to the investment bank. They don't hold it anymore. Okay? They sell it to investment banks, get some money out of it, and it's fine. So more loans, better it is. And why subprime? Okay, why my first question 2 minutes before? Why couldn't or didn't investment bankers make good quality investment products and try to sell it to their customers? Because subprime is more profitable. This is so sad. Okay. Because if it's a good quality mortgage product, so you need to consider two things. So how much you're borrowing out of house price. So if a house is $1 million, are you borrowing 100% of the house price? Only 50% of the house price? Okay. So lower the ratio of the housing price you're borrowing. It is a safer product. It's a safer mortgage for um, the banks who are selling these mortgages, creating these mortgages, I should say, for the borrowers. Okay? So, safer, better quality mortgage, interest rate to the borrower is lower, right? And if the borrower is borrowing everything for the house, if the house price is $1 million and the loan is $1 million, that's a bad loan. That's a bad quality, high risk SHIT loan. We call this subprime. Yeah, as name implies, subprime. It's SHIT. Okay. And the interest rate that borrower has to pay when they get the subprime loan is higher. What does this mean? It's more profitable for the banks to give out subprime loans to their customers. This is tragedy. This is totally unethical, immoral. This is a disaster. It's just asking for trouble. And there are two things, right? You should ask yourself, like, why would they do this idiotic action of giving out this subprime loans? Because if the borrowers cannot pay the banks, then party stops. Everybody lose money. It doesn't circulate anymore, right? So we need to talk about this. I forgot to mention one thing, so let me backtrack. So percent portion of the housing price you borrow is called LVR, loan. Yeah, it's short for something. It will come back to me. Sorry, give me a little bit of time. Okay. Loan valuation ratio, I think. Okay. So it's a percentage of the housing price you're borrowing. And second, determinant is DSR, debt serviceability ratio, meaning how much income the borrowers have to be able to pay monthly payment. So ability for these borrowers to be able to pay monthly payment. That's DSR. That determines whether loan is good quality or bad quality loan. Okay. So if he has a good job, so he is earning $10,000 per month, and he is employed, so it's safer. He works for a company. He makes a lot of salary per month. Then it's a good loan, safer loan. And if someone is not making a lot of money, then obviously it's a riskier loan. Okay. But if you give a loan to this kind of guys, then you cannot charge a lot of interest. So profit for the banks are lower. But if you're making a riskier loan, you can charge him higher interest. So higher interest here means the price of the home loan as a product is more expensive to their customers. So they can make more profit. You see how it world is working and going and ending? It's a total disaster. It's a totally corrupt, totally unethical, and immoral. Okay? And you probably ask me or ask yourself, I mean, how can they be such an idiot to think that way? Because if you create bad loans and lend money to people who cannot pay it back, then ultimately these CDOs will be collapsed, or you cannot make CDOs anymore because these loans will not exist because they cannot pay the bank back. Okay? So this is a normal mind, conservative mind. Okay? All right? The banks thought it doesn't matter. Okay? I'm just selling the mortgage as long as I create one and I earn some fee. So I get out of it. It's fine. Okay? So let's give mortgages to anyone for me to make more money. Okay? And investment banks and other parties involved who would be affected made two very, very dumb, high risk, short term, profit oriented assumption. First assumption was everyone will pay their mortgages no matter what because it's a necessity: house, food, clothes, right? So nobody does not pay their mortgage because nobody wants to lose their own house. But the problem is there are exceptions. Okay? Somebody might lose their job or they run out of cash. You know, things happen. And if you don't have money, you don't have money. If you don't have cash flow, you will not be able to make the monthly payment. So this is a very dumb assumption. And more importantly, second assumption is more critical. Because I have the mortgage is created on house. So if the borrower do not pay me back, then I take his house, sell it, put it on an auction, and get the money back. And because house price always goes up, or it's very stable at least, or gradually go up, house price never goes down. Even this guy cannot pay me back, I can take his house and then sell it to the market and make everything fine. But never say never. Okay? So if there is a recession for a number of reasons, especially if many borrowers who got the loan that they cannot pay back, and if this becomes 1,000, 10,000, million, 10 million, then more and more borrowers imminently, obviously, will not be able to pay their loans back and default on the loan. If there are many people like this created, this is the best recipe for house price to fall, right? And there could be a recession, there could be a number of different reasons. It's not very likely in a long run, but you cannot just assume since house price in a long run will not really never go down, so we can still take the house from the borrower and sell it. And as long as house price do not go down, we will be fine because we can sell the house to reduce or eliminate our loss. So we'll never have loss. these are two assumptions. The movie doesn't really tell you this. This is my created contents. These are the two finance assumptions people have so that they can make a dumb thing like this and just creating subprime loans and having a party, and they think they're geniuses. They think they're a financial innovator to create big money, create big profit. This is how it happened. And I talked quite long and explained this in detail because the movie doesn't really tell you about this part. Okay. All right. Now, stage is set for part two, bubble. Billions of dollars are flowing into securitization, food chain that I explained, and nobody cares anymore. They're issuing more loans, and this means more profit. And, pretty much, if I may exaggerate, anyone can get a mortgage. So that means, by definition, bubble in the market. Okay. And I already stated, but real sad part is not just more loans are being pumped out, the more bad loans, better for the industry. So stage is set for bubble, but really, really, like accumulation of bad loans, subprime loans, to maximize the market that one day will burst, and the whole securitization food chain, because there is no longer compartments. Okay. General public who borrowed, commercial banks and savings and loans company, big investment banks, and all the investors, individual, institution, fund managers, government, everyone will be destroyed together at once, because there is no separation whatsoever. And this is exactly what happened in 2008 through a global financial crisis. Okay. And if that's not bad enough, there are 2 or 3 or 4 things that happened during the bubble that made the bubble worse. So first is there is a guy called Henry Paulson, or Hank Paulson. At the time, he was a CEO of Goldman Sachs, and he successfully led these initiatives along with, I'm sure, other CEOs of other investment banks and other financial institutions. Okay. He successfully made regulators, Security Exchange Commission, who is supposed to protect the investors' money, the regulators to allow this investment bank to increase their leverage on borrowing, which is crazy. So let's say it was around 15-1 leverage allowed for investment banks. So investment banks were allowed to borrow $15 for every $1 they had in asset. This leverage was increased to 33-1 during the bubble. And the financial regulator allowed this to happen. I mean, this is so risky, right? So this made a bubble a lot worse, I guess. So this means if you had $3 in asset, you are able to borrow $99 and invest that money in risky assets and create CDOs, right? And another factor that made this bubble even worse than it was already, if it cannot get worse enough, was AIG selling the product called credit default swap. This was really bad. So because AIG is an insurance company, so they create a product called credit default swap. And how it worked was investors who owns CDOs, they want to buy some insurance. So AIG sold credit default swap. So if the CDOs are collapsed and if they have credit default swap, they can get large sums of money, insurance money from AIG, but they have to buy the insurance policy called credit default swap to pay monthly payment to AIG and buy credit default swap. Okay, because there were lack of regulation, AIG was selling a lot of credit default swap. Now, looking back at the history, it's so obvious that CDOs will go bad and AIG need to come up with some kind of money ready to pay them out. But at that time, they didn't think this way, foolishly, okay? And they were having a party. And every time they were selling credit default swap to the buyer of this swap who hold CDOs, they were paying out high rate bonuses to people, employees, financial planners who were able to sell credit default swap, which was very profitable because they received premium every month by selling this product. Okay? But due to lack of regulation, they didn't have the money ready to pay them out when and if CDOs turn bad. So this was totally ticking time bomb, or even worse, it was putting oil into a wildfire. Okay? And number three, of course, investment bank do what they do best. Become immoral, unethical, and trying to just make money off their customers' back. Like, they make money like gangsters or drug dealers. I don't know. I mean, it's just really horrible what they did. Okay, so led by Goldman Sachs, of course, being number one, smartest and brightest. Okay, number one investment bank in the world, right? These investment banks start buying, of course, credit default swap to protect themselves. Okay? So this does two things. So Goldman Sachs can be, they are sellers of CDOs, but they are creators. So let's say they have some remaining position. They wanted to sell this SHIT and get rid of it, but they still hold some CDOs. Then if they buy credit default swap, then when CDOs collapse, they can get huge amount of money from AIG to cover themselves. Plus, in derivatives world, I don't know why and how this works. Okay, so going back to the sports bet example, England and Germany football match is a main bet. Sports bet, just like derivatives, you can have a side bet without a main bet, right? So you don't have to have a bet, main bet, that England versus Germany game for you to put a side bet that put money on Harry Kane to be a first scorer. You can only buy derivatives, right? You can only buy first goal scorer, Harry Kane bet without having the Germany England game bet, right? So derivatives works exactly like that. Okay, I don't know how is this possible. So when you insure a house in a real world, you have to own a house to have an insurance, and only the owner can insure his or her house. One person or one entity, the owner. Okay, but in a derivatives world, without having the main investment, main product, they can only buy derivatives if they want. So, house example, million people, if the seller of derivative decide to sell insurance policy to 1 million people, 1 million people without owning that house can only buy the insurance policy of that house. That's how derivatives work. So Goldman Sachs and other investment banks are keep buying credit default swap, especially Goldman Sachs and Morgan Stanley in particular. Smarter guys, I guess. Okay. They are stacking money on credit default swap, not to just cover their own position, but as a speculator to gamble. Okay. And what is a problem with this action ethically? This proves that Goldman Sachs believe credit default swap, CDOs are SHIT. Goldman Sachs is admitting by their action that, that they believe CDOs are bad investment product. But what is the problem? They are keep creating and selling this, what they think as a bad investment. Plus, they are buying credit default swap to back themselves, to hedge their risk, to, put both hands into both pots of honey at the same time, right? This is totally unethical. And buying credit default swap to speculate and profit even more at the expense of your own investors and your own customers' loss. This is fact. Unbelievable, isn't it? Totally unbelievable, but you better believe it. This is true. This is true. Unbelievable. At this point, I think it's about time we learn about how rating agency works. So we already covered these Moody's, S&P, and Fitch. They give AAA rating to CDOs. which is totally shocking. Okay, because they are paid by their customers to give good ratings. This is the nature of the business. And in a Big Short, it's described in detail. It's fun to watch. Okay, that part. And when they were investigated and charged, and they hired lawyers, and their defense was, it is the ratings we give out is purely our opinions. What is this? Like what is point of your existence? You're a cockroach. Okay, you're a disease. You're a bacteria. You're a virus. You're worse than anything. Okay, they claimed it's our opinions. If you watch the movie, they say it's purely our opinions. The credit ratings that we give out, it is just our opinions. Why? What is the point of your existence? So that's how rating agency work. You got me. I don't know, but this is a reality. And stage is set. That's end of part 2. And the tragic part has to come. Part 3. Crisis. And the part starts with Ben Bernanke, the chairman of the Fed Reserve at the time of the financial crisis, being interviewed in one of the news program, and the time was July 2005. So to be fair, so this is even before Ben Bernanke was appointed as a chairman of the Federal Reserve, because he became chairman of Fed 2006 February, if I remember correctly. Okay, so this news interview was taken July 2005, and the news anchor asked Bernanke a question. She asks, there is a rumor in the market, there is a huge bubbles are building up that will, someday burst into a recession. And when that happens, the housing price will collapse and there will be a huge problem in the economy. So what do you think about that rumor? And if the bubbles are real, and if they do burst, what kind of implication would that have in our economy? That was the question. And I'm paraphrasing, guys. And in the movie, Bernanke answers the question by saying, I don't believe in your premise. And his reasoning was, that's pretty highly unlikely, he said. And there was never house price decline nationwide in the history of US. So that was his reasoning. And when I heard that, I thought it was a very weak answer in terms of being logical. I thought, he was a little bit complacent, not very diligent at his job, because he was already one of the governors for Fed Reserve. He was already working for the government. He was already working for Federal Reserve as one of the top governors, because he joined Fed Reserve around 2002, I think. Okay. So I thought he was very incompetent at his job. And also his logic is quite weak. Never say never. Because something never happened, it doesn't mean it may not happen in the future. And type of housing bubble that was being created from, let's say, early 2000 to 2007, especially from like 2003 and 4, which highlighted, they never had this kind of crazy bubble before. So, you should be more careful and good at your job to look at the economy more closely, in my opinion. Okay. So this leads to one of the main criticism that the director of this movie have on Fed Reserve, which I strongly agree with. Director interviews the one of the former governor of Federal Reserve, Mr. Mishkin. Look out for this guy. I was able to laugh more than a couple of times by his comments. And this guy, just to give you what happened, because it's already history, he actually quit Fed Reserve sometime in 2008. I think it was like August or something crazy like that, right in the middle of financial crisis. He quit the Fed, and his reasoning was he's going back to his old job, teaching at Columbia Business School as an academic professor, and he needs to revise textbook. Okay, so things like that, he says. And when the director of the movie interviewed Mr. Mishkin, former governor of Fed Reserve, the director asked, why didn't you look during these times? Why didn't you look at the problem and situation? And Mishkin replies that we had a look. We had a number of people looking at it every day, but we didn't find it anything. And the director disagrees and say, if you actually had a look, you would have found it. It's obvious that you didn't look. You didn't make enough effort to, monitor how bad the bubble was and what was happening in economy. You didn't look. You didn't work hard enough. You weren't doing your job properly. That is a claim the director of a movie makes. That's my opinion as well. I think they should have done a better job identifying how bad the bubble was and do something about it to potentially, who knows, right? Prevented the crisis altogether, or make it a lot better than what happened, and take action to these investment banks during the bubble. They should have taken some actions to Lehman's, all the investment banks and all these crazy institutions. They should have done that. And director explicitly criticizing that point towards Federal Reserve, which I do agree with. Okay. And the next point we're going to look at, this is extra information that I came up with to share with you guys. This information that I'm going to say right now is not a part of the movie. Let's really look at what was initial start of a major recession. There were clearly two signs, okay, that was really big and official. First, 2007, sometime in July, the Bear Stearns came out and admitted to their investor two of their funds that had a lot of mortgage-backed securities and CDOs, two of their funds completely lost its value. So Bear Stearns officially admitted they lost two funds. It went to zero, okay? And those funds will consist of a lot of mortgage-backed securities and CDOs, okay? And a month later, BNP Paribas, sorry about my poor pronunciation, the French bank, they froze three of their investment funds and admitted that these funds that have huge exposure to US subprime mortgage products are in trouble. The subprime mortgage product and market right now in US is collapsing or already collapsed. That was their claim, and said they are freezing these funds, so no withdrawal of 3 of our funds for a time being. So at this point, obviously, retrospect, if you look at the numbers, US mortgage market had already collapsed, especially subprime market. Okay, collapsed, finished. There were a huge number of foreclosures starting, meaning, banks taking over the borrower's house because borrowers didn't pay their monthly payment and defaulted on a loan. It was already happening, or it had happened a lot. There was already collapse of US subprime mortgage market from 2007. So it's not like, Lehman Brothers went bankrupt overnight. Okay. So in this regard, the director of the movie criticizing, Federal Reserve didn't do anything, or at least didn't do a very good job until this point, is very valid in my opinion. And because we can objectively say the government and the regulator were definitely behind the curve, behind the ball when crisis was initially starting. Let's actually talk about actual crisis. March 16, it was 2008. Bear Stearns ran out of cash and was taken over by JP Morgan and government, Federal Reserve. It was bailed out. Okay. And this is definitely partial government bailout. It wasn't a pure private sale because JP Morgan took over Bear Stearns. So Bear Stearns, in their own right, they're fifth largest investment bank in US. JP Morgan bought Bear Stearns with $2 a share, and government put up $30 billion as government guarantee to this takeover. So unfortunately, it was indeed partial government bailout as well. September 7th, another huge event, if not bigger than Bear Stearns. Okay, certainly not smaller. Fannie Mae and Freddie Mac, cute names, mortgage companies, two biggest mortgage companies in US, savings and loans company. The movie claims these two institutions holds up to 50% of all US mortgages. Okay? And they were bought out by government. Okay? We are in a crisis now. We are on a verge of this financial system being stopped. Okay? Pretty scary. Okay? And of course, this guy. September 12th, they informed the government and New York Federal Reserve that they ran out of cash. They cannot survive another day. Lehman Brothers, number 4 investment bank in US. So this is Friday. So the US government Treasury created a meeting to meet with all the major CEOs of the biggest financial institutions. So obviously all the investment banks, but other financial groups like JP Morgan, Bank of America, Citigroup, and all of them to figure out a way to buy Lehman. Okay. So they had a meeting, and another merger actually happened during this weekend. Merrill Lynch, number 3 investment bank in US. They confess they are also in huge trouble. They won't be able to survive not much longer. So Bank of America take them over. Okay. So this deal went through. And was there a potential buyer of Lehman? Not from US, but there was one buyer, potential buyer, who showed interest in buying Lehman Brothers. That was Barclays Bank in UK. Okay. And there were 2 major challenges. UK government made it absolutely hardest possible through the regulation and legislation they had in attempting to block this merger. Okay. British government didn't want Barclays to take over Lehman Brothers. And second, because of that and all the other things, during the weekend from Friday, Barclays demanded financial guarantee from US government. So they also wanted to make this merger like how JP Morgan took over Bear Stearns. And for a number of reasons, US government. So now Treasury Secretary at this time was Henry Paulson, who was former CEO of Goldman Sachs, who started this job from 2006. Okay. US government, the Treasury Secretary declined, refused the offer. So Lehman Brothers became history, went bankrupt. So this is a series of events. And September 15th, Monday, the tragic day, probably single worst day, certainly one of the worst days of financial market in the history of capitalism. Lehman Brothers declare bankruptcy. Okay. And, financial system had stopped. There was no circulation of capital. Nobody could get credit, meaning nobody could borrow money. And everybody was losing money left, right, and center. Stock market around the world was doing this. And it was a horrible day because it was really scary day. I mean, some journalist articles, I remember, there was a saying that, is this end of capitalism? This is worse than Great Depression because today the financial system had ceased to operate. It stopped. So it was really scary day to witness this happening around the world at the same time. Okay. And if this is not bad enough, the next day, what happened? You remember, right? AIG raised their hands. Okay. Excuse me, we don't have cash either. We're going to go bankrupt tomorrow. Okay. So obviously they had a commitment to pay credit default swap that I explained in previous episode, that they were committed to pay up as the CDOs are being collapsed left, right, and center. And of course, they didn't have the money. They didn't, have the capital required to pay them out. And we experienced the market without Lehman Brothers for one day, September 15th. And when at the end of the market day, AIG confessed to the government, there was, looking back, just like not, it wasn't an option to let Fannie Mae and Freddie Mac fail because they hold 50% of US mortgages. Just it will be mayhem. It will be hell. Okay. Just like that, AIG was the number one largest insurance company in the world. So of course they have all the insurance policy from investment banks and all the financial industry, plus all the individuals. Think about that. So if they go bankrupt, all of the insurance policy of the financial industry become toilet paper. And I mean, I don't know how many billions, I don't know, of insurance policy of individuals, life insurance, it all disappears. It's just, it's hard to even imagine. So AIG was too interconnected to be to fail. Okay. So government stepped in and they announced they're going to bail out AIG on that day. And they immediately inject necessary cash to start bailing them out on September 16th. Okay. And it's a long story short. It is a long story. At the end, the government proposed and it didn't went through in the first attempt. If I remember correctly, it finally got passed second or third time. But anyway, the story is the government proposed and the Congress approved 700 billion US dollars emergency bailout fund was approved to resolve all this mess. Okay, bail out AIG and put necessary cash liquidity back in the market. That means i.e. investment banks and troubled financial institution. So US government came up with, they can just print money because of US dollar. So Fed Reserve came up with $700 billion to resolve financial crisis of 2008. So just letting you know, this was the conclusion. This was a resolution. Okay. And that's part 3, crisis. Part 4, without further ado, let's start right away. So aftermath of the financial crisis, obviously it's only just to find out who are accountable, responsible for this huge financial crisis and, make everything right. Give them right amount of punishment, I guess, is important. So part 4 talks about accountability, and it's quite angry. I mean, made me angry, at least, about this content because, nobody was held accountable. That's the summary of the part 4. So, the part 4 starts with the disgusting testimony of the CEO of Lehman Brothers saying something like, "We did well when the company did well. Sir, we did not do so well when the company did not do so well. So the system worked." He said that. So it was rather disgusting, annoying, to say the least. He took home over 5 years. He took home something like $456 million. I mean, I don't know what this means. I've never seen it. I will never see it. I cannot comprehend what $456 million mean and is. He took home about $456 million over 5 years. And the top 5 executives of Lehman Brothers during 2003 to 2007, they took home $1 billion in their remuneration, their pay. Okay, the individual positions pay, 5 of them were $1 billion. And they didn't have to pay any of it back during the bubble. Okay. And all the other companies as well, you know, companies that actually went bankrupt during 2008 or not, you know, Bear Stearns, Citigroup, what else were there? AIG. AIG CEO was fired, at least when the government bailed them out. He was fired on that day. Okay, but he still kept the money that he made during the bubble. And the bigger problem is many executives that actually were resigned, allowed to resign, even their company no longer exists. So this is example of Merrill Lynch and what else were there? Sorry, I can't remember all the names, so please reference to the movie. And these companies that went bankrupt, so you know, systematically the CEO's job had disappeared, right? And many of them, not all of them, factually, because the movie kind of implies every one of them, but that's not true. Most of them got the severance pay, so they actually got the retirement additional bonus pay when their job disappeared in 2008. How does that work? Like, aren't they accountable, at least partially, if not majority? Aren't they accountable or responsible for failure of the company? So that's the reason why their job no longer exists. It disappeared because company disappeared, went bankrupt. Why are they getting severance pay? I don't know. You got me. Okay. So the movie, according to movie at least, the nobody was held responsible, accountable. And the reality is the banks, i.e. financial institution, the big ones, they become even bigger, more powerful, and more concentrated than ever before, and gives more detail. So, you know, in a sentence, nobody was held accountable or responsible for the 2008 global financial crisis. That was the conclusion of it. That's another criticism by the director of this movie. Okay. And he talks about lobbying power, how the financial service industry lobbies the politics. Okay. There are, because lobbying in US is legal. Okay. Like, you are allowed to lobby. That's fine. Okay. 3,000 lobbyists work to represent financial service industry. This number, to understand, is 5 times more than the member of Congress altogether. So director is trying to say, you know, per member of Congress, there are 5 lobbyists from financial service industry working on each and every member of Congress. Okay. And amazingly, from 1998 to 2008, the movie claims must be a public information. They spent $5 billion lobbying. $5 billion. A lot of money, $5 billion, if you think about it, over 10 years. Okay. And the movie is claiming then that they are spending even more money now to resist the reform of the financial service industry, to leave the industry as it is. All right. And at this point, I thought the director of the movie make a very, very interesting and controversial and somewhat subjective claim that financial service industry use another tool, resource to just like lobbying, but a different method to influence the politics, shape the finance industry, and make it more powerful. Okay. According to the director, the tool they use, resource they use is academics. So that's referring to economics professor. I mean, I partially agree with this, but I partially disagree also. The general claim, the main claim he made, I have to say I don't agree with the director 100%. It's very controversial, and I don't think you could just criticize that as a whole. I didn't think that. I'm not saying I'm right, but I just thought that way. But the second point he makes is a very clever and very, very good one, I thought. So, you be the judge. So the movie talks about these academics who became the government official, very high position, including chairman of a Federal Reserve, or become highest position in government dealing with finance, treasury secretary. So these guys, some of these guys come from academic background. For example, Ben Bernanke was a professor at Princeton University. Larry Summers was a Harvard professor. Okay. And they become the government official, and they were the one who were architects of deregulation. The movie is criticizing for this already because the director of the movie, in my opinion, does not believe in deregulation. He believes in more regulation. Okay, so he criticized not only these professor who becomes important personnel in decision making finance for US, mess this all up by deregulating. And then even after they retire the government jobs, they come back to universities and also keep influential to the market by being board member of major financial service institutions. Okay. And, they become like consultants and advisors to the industry to make the huge amount of money. And in essence, there is something wrong with that. And also the movie claims, not me, there's something wrong with that. And this is how it works. So, just like lobbying to influence the market and politics, economic professors are used this way. That is a claim. Interesting claim, somewhat controversial. And another detail point he made, which I liked a lot better, is that these economic professor, it is their job to create a report, write thesis, write an influential paper, do the research to inform and influence public. That's professor's job, right? So when they do these work for the financial service industries, quite often they do not disclose the payment detail, okay? Whether they were paid or not. sometimes you have to disclose some kind of paper you write or work you have to do, but not always. Sometimes general public doesn't know whether that professor is expressing that opinion wholeheartedly from himself, or they're actually professionally paid to do the work. It's not always disclosed. Sometimes it's disclosed, not always. And the industry and the university and one of the chairman, very high president or a high position in Harvard University is interviewed for these questions, and he's totally grilled, and he doesn't know what to say back. And this interviewee says they don't know. They don't know what kind of regulation, legal framework are in place to disclose these professors' commitment, and whether there is a conflict of interest, or conflict of interest in terms of financial benefit, like whether they're paid to do this work or not. And these super smart, intelligent president and chairman of a university, they stutter, they mumble, they can't say anything. All right, because ethically, I mean, whether they do the work or not, I think it's a less of a problem. I don't have a huge problem with it, because as an individual, you are allowed to have your economic philosophy, your opinion, and that's your job. Like you have spent all your life studying this field to have your own opinion. That's what PhD degree and above is about, right? So I think that's fine, but certainly to prevent conflict of interest and ethical code of conduct, I think they should disclose. This should be public information, whether this professor is paid to do this paper or not, and exactly how much. I think it's necessary. So I understood this as a kind of general claim. This is wrong generally. This is wrong. This is wrong. This is wrong. Look at these bad guys. Possibly, but for me, I don't know how much, to the degree that I could relate to that claim or agree with that. Obviously, it's not ideal, but there are some things that I did not agree with the director of the movie. But this specific claim, that I agreed a lot stronger, because it should be disclosed. Okay, that's the main part, I believe, of part 4 accountability. So it is a lot shorter part, and I tried to make it concise as possible, but at the same time I wanted to say everything I wanted, so still it became a little longer than I thought. So this is the last part, the ending part of the movie, where the director of the movie evaluate U.S. economy and U.S. as a country, and say his final words, final advice, opinion, and suggestions to U.S. and U.S. economy. So the part starts by director, actually Matt Damon, through the voice of narrator, Matt Damon, saying essentially U.S. as a nation became more unequal society since 1980s. So before 1980s, until 1980s, U.S. was more equal society. There was less polarization, strong middle class. But since 1980s, U.S. became more unequal society, and I don't think this is just a concern for U.S. Most, if not almost all, developed countries' economies are actually having similar experience, as you know. But this is a main claim of concerning voice of Matt Damon saying that US became more unequal society since 1980s. And he points out two main points, two main reasons. First of all, they used to be a market leader, global market leader in manufacturing industry, like autos and steels and things like that. And gradually from 1980s, for number of different reasons, they have lost to their foreign competitors in this manufacturing market. So they are not leader in the manufacturing industry anymore in terms of economy. And now different industry has developed in US. For example, now no longer leader in manufacturing. So, a lot of jobs, I guess, went overseas that, they can pay cheaper wages to be competitive to against their global competitors. And now different industry emerged. For example, like IT industry. Okay, tech industry, without any hesitation, US is global number one at this point in time. No debate there. Okay. So there are many high paying jobs, but the problem is these jobs to enter IT industry require college education, right? And because the society has become so polarized, there's huge gap to have and have nots. And the college education is becoming more and more out of reach for average families. So in turn, it will do a 360 and more. Because of this cycle, it will create even more unequal society, wouldn't it? Okay, right. So that's one point that he wants to mention. And the second reason why there's such a huge gap between the rich and poor is that during George Bush administration, George W. Bush, the son Bush, he introduced a tax policy that strongly favors the super rich in the country, top 1% of the nation, and kind of it is bad, worse tax system for remaining 99% of the nation. So, director of the movie, through the voice of narrator Matt Damon, makes this point. US became more unequal society since 80s because of the types of economy, nature of the economy, and the university education is too expensive for average families. And secondly, the George W. Bush administration created type of tax policy that favors only top 1% or even 0.1% of the nation. And it is a worse tax policy to make them poorer for 99% of the nation. That's a claim. Okay. So one point he makes. And who comes into office? Who becomes president? The superstar. Okay. The savior, right? So Barack Obama, indeed becomes president and he took office. Okay. And according to the movie, you be the judge. Okay. During Obama administration, 2010, he did pass a new act, new legislation, new law called Dodd-Frank Act. Okay. And the movie talks about it doesn't touch some parts of the problem, including how these executives in financial service industries are compensated, remunerated their pay structure, which I think is a huge problem. But the movie overall think this legislation that Obama has put out is very, very weak. I don't think it's a very, very weak. I mean, it is unfortunate. It's very hard to completely change the nature of the industry in one day. So I'm sure, including compensation area, that it is a bit disappointing that not more was changed more radically. So the movie implies it was a very weak move. Nothing significant really changed. That's claim of the movie. So I think if you're interested, you should check it out and see for yourself and see what's changed, what's not changed, and how you judge this change as a good one or bad one, significant one or very, very weak one. And according to the movie, because movie certainly has a perspective and a voice, and this interviewee, who was a former director of a consumer advocacy group, he mentioned, why this happened? Because it is Wall Street government. Okay. So he too, with the director of the movie, certainly criticized this point. And Wall Street's are super powerful with lobbying money, and they got, Republicans and Democrats, the whole politics and the government, under them. That's their claim. Okay. So this is his final words through Matt Damon's voice, narrator. For decades, American financial system was stable and safe. But then something changed. The financial industry turned its back on society, corrupted our political system, and plunged the world economy into crisis. At enormous cost, we've avoided disaster and are recovering. But the men and institutions that caused the crisis are still in power, and that needs to change. They'll tell us that we need them and that what they do is too complicated for us to understand. They will tell us it won't happen again. They will spend billions fighting reform. It won't be easy. But some things are worth fighting for. So that's his final words, and the movie finishes. Okay, so as you can see, he's urging us. He has, rightly so, with his reasoning, he has a huge mistrust on government, financial institutions, and regulators, and the whole industry, and what is happening right now, because he believes people who are accountable and responsible for bad action are not changed. They're still in power. So he doesn't like that. So we should raise our voice and keep our eyes open to create the change necessary to, go back to more stable and safer economy and financial service industry. I think that's what he's saying in his final words, with my understanding. And yeah, that's the end of the movie. What do I think? Great movie, great, a lot of facts and evidence, a lot of great effort to make his argument very convincing. And, I have kept saying a couple of times that I don't believe in more regulation for sake of regulation. But at the same time, I don't agree with no regulation. That's equally bad. So I think, to the degree, it may be about deregulation or not, but what's more important is what kind of regulation we should choose to adopt. And even more important thing we should address, in my humble opinion, is that, we should really learn a lesson how government and regulators were kind of behind the curve and behind the ball during the bubble stage, and kind of admit that fact and be humble about it, or even if they don't admit, going forward, the government and regulators, hopefully do a better job watching over economy in more diligent, professional, and competent manner. That is my main take of watching the movie. That's what I want to say, and I'm super thankful and appreciative of this movie. And I think this movie is great in so many different ways. It gives us a broad understanding of industry and the history and development, and it gives us a great diagram of the securitization food chain model and the older model. And people can learn so much from this movie. So, I think it's a great movie. So for me, I'll come back with probably another movie to review, have a little bit different focus. Okay. Thank you guys. See you in my next video. Thank you.